Okay, the news has been on fire lately. You're seeing that there is a very high likelihood. In fact, I will put a nearly 100% likelihood on it that we're going to see a Fed rate cut in September and probably one more after that. You've seen the job reports coming in worse than expected. You're probably seeing that the inventory numbers are up all around the country. You might have even had a call from your local lender saying that rates are at the lowest they've been in a long time, which is technically true, but they haven't shifted all that much. And if you are one of these buyers who's been on the fence, you might be wondering if now is the time to jump off the fence. That's a question we're going to answer for you today. The market has just shifted. Do you want to be one of the first people in? Or is it a time for some caution? By the end of this episode, you're going to have the answer to that question. My name is Rich Curtis. This is the Informed Homebuyer Podcast. Welcome back. And I have with me, as always, my co-host, Dave Miller. How you doing, Dave?
I'm doing okay, Rich. Like you, trying to get through getting over being sick, but I'm going to power through and excited to talk about what we're going to talk about today. There's a lot of moving parts right now.
Yeah, the kids are back in school. Dave and I will be sick pretty much nonstop until June again. So the show must go on. If our voice is a little scratchy, we apologize. So let's run some headlines for people. So the jobs report got adjusted downward, saying that we actually added nearly a million. It was 911,000 less jobs than previously reported. That's a big number. Jobs came down by nearly a million, and that caused kind of a flurry of activity in the market, didn't it, Dave, even after that announcement?
Yeah, it certainly did. And we were anticipating that these numbers were going to be off, not this much. And, everything's indicating that when the Fed meets next week, that they're just going to be a rate cut. But I think there might be some, I don't know, some extra motivation in these numbers to encourage that rate cut. So
Yeah, and I think we were seeing analysts and project. There's all sorts of people on Fed Watch who give their likelihood, their percentage likelihood of a projection, and most of those percentages across the board were in the 90th percentile that we were going to see a rate cut in September. And once this job report came in, dropping that, and then we also did have a sort of another round of inflation numbers came in that showed inflation relatively flat. So we got inflation relatively flat, job market softening, and instantly all those analysts bumped up their Fed rate reduction likelihood to nearly 100%. So we've got a lot of confidence out there in the market that the Fed is going to drop the rates on the September 18th, right, Dave?
17th, yeah, they meet on the 17th. So I think we'll know that the Fed speak might be the day later here, but it is the 17th.
Yeah, so we've got a pretty big likelihood we're going to see a rate reduction there. The running prediction was a quarter basis points, so 0.25. But there are some people calling for a bigger drop. People are calling for a 0.5% reduction. I'm not so sure with the measured approach they've been taking so far that they're going to come out swinging with their first rate reduction in a hell of a long time, since 22, I think, at a half basis point. I'm not willing to hang my hat on that, but I do feel like we're going to see that 0.25 next week
Yeah.
on the 17th, 18th.
Yeah, I agree with you. I think they'd rather continue the trend of continuing to lower each opportunity, each meeting versus going too much at one time and then having to pull back. That's not going to help anyone. And still waiting, kind of like the data, they're always waiting on the figures, which is always trailing data. And the data now suggests, yes, the time is right. The last people can point back and say, yeah, you should have cut last time, but the data wasn't there. And
Yeah.
so,
Yeah. Hindsight's 2020.
yes.
Well, now, Dave, if people are frequent watchers of the show, which I hope you all are, and if you're not, go ahead and hit like, hit subscribe, click that little bell icon so you don't miss future podcasts where we break this stuff down and help you make the highest quality real estate decisions you can from the comfort of your couch. But in case people haven't watched every one of our episodes, let's go over once again for them the fact that 0.25% cut in the federal funds short-term rate does not equal a one-to-one, a 0.25 cut in the mortgage interest rates. Is that correct?
That is correct, Rich. In fact, oftentimes we'll see that, and we won't even see an instant improvement in mortgage rates. We might see a minor improvement, but we've already seen over the last week or so, we've seen the best kind of run we've seen in a while on mortgage interest rate improvement, which is in anticipation of a Fed rate cut. So it's already being priced in. And the bond market is accepting this, and where we're at, if you look at the 10-year note, we're right at 4 right now, which is lower than we've been in a long time. So right now, if you were to ask me, we're even if the rate cut comes next week, we're going to probably be sitting where we're sitting right now. But it just
which is
supports that we're trending. Yep.
yeah, which given a range, because we can't say specific rates it's based on your credit and income situation and everything else, but a reasonable range right now of rates. What's that as
Yeah,
of
I would
today?
say on a conventional buyer, you're probably looking in the low to mid sixes. Um, so low to mid sixes, or just under 6.5. We've just kind of cracked that. So I'd say, week and a half ago, we were just over 6.5. Now we're under 6.5 for the right buyer in that range. So we'll say 6 3/8 to 6 5/8 seems to be kind of the range we're sitting in, and that's for conventional, and even lower for an FHA buyer, or borrower, I should say. So typically, we're going to see at least a quarter better in FHA rates. But I wouldn't be surprised if we continue to trend like this, and the numbers. I think three different numbers here are all pointing in the right direction. We continue to see that we will see rates gradually improve. My anticipation is by the end of the year, we might crack high fives on conventional. Um,
Ooh, that's a
that's
bold prediction.
it
High
is a
fives on
bold
conventional.
it
All
is a
right.
bold prediction, and I'm not saying we're going to stick there I'm just saying, or for every buyer, but if everything checks out and we continue on the trend we are, we potentially could see ticking down. That could be 599, right, or 5875, and it might be for a day or two, but I think that's the trend
Anything with a 5 in it would be exciting.
I think so for both of us, and for the all the buyers that are on the fence, and folks that maybe purchased with higher rates can now look to refinance those rates. There's
Yeah.
several folks out there with 7% rates, and I talk to these folks all the time, and hey, should I refinance? And they come to me, and I let them know, I'll contact you when it's time to refinance, and I just wouldn't want to pull the trigger too soon. Granted, you could refinance multiple times, but there's a cost associated with doing it. But I think
Yeah.
it's prudent to wait here. I think there's still a little bit more improvement to go.
Yeah, and I think we're gonna get deeper into that because I think both of our phones are blowing up right now with people being like, "Hey, rates are coming down. Should I do something?" And that's the question we're going to answer here. But I want to get through a little more of the headlines. I do want to stick a pin in something important you said that I don't want to get lost, which is that most of this is already baked in. So David mentioned we had a really good run, the best run we've seen in a long time, the last week in the mortgage interest rates. That run was not based on a Fed interest rate cut. That was based on these revised numbers. So if we anticipate things and things happen as we anticipate them, the mortgage interest rates don't move. They only really move on surprises, right? So
Right.
right now, everybody believes that there's a 100% likelihood that the Fed's dropping at least 0.25 basis points. And if the Fed drops 0.25 basis points next week, then or 25 basis points, 0.25%. We're not going to really see movement in the mortgage interest rates. If they were to drop at 0.5% when we were expecting the 0.25, all right, we might see a little movement. And what's happened in the last week was that revised job numbers, coming down by 1 million, and those inflation numbers looking more stable. So those were two unexpected pieces of financial data that dropped, and we got movement. Everybody's expecting this 0.25% drop, and so that's already baked into that movement that we just saw. So on the day when they announced this 0.25, we're not expecting a whole lot of shift unless they come out and swing for the fences with a half a point. Is that fair to
Right.
say?
That is very fair to say. And I think, like anything, it's always backwards looking. They'll make this quarter point adjustment. If inflation stays where it's at and doesn't tick up any higher, then I can see they'll continue to do these quarter point decreases. Now, if for some reason inflation were to drop and the unemployment numbers stay elevated, then at that point I could foresee maybe them considering a higher, a half a point interest rate drop at the Fed fund rate level.
Yeah, I think that's I think they would do that. I think that's unlikely given that we are starting to see the tariff pinch come out in the data. We're finally starting to see the effects on the economy of the tariffs now in a measurable way, which I think is also contributing to the job loss situation. And so I think it's unlikely that the inflation continues to march down. But to be fair, I'm a little shocked at how stable it is now. So it could continue to spread.
Yeah.
The economy was so strong, up till about 6-8 months ago,
Yeah.
that it's proving to be pretty resilient at the moment, more resilient than and even more resilient than the pundits and experts thought it would be up to this point. So I don't think
Yeah.
we can count it out yet.
And I think the other important thing for folks to know, and I don't like, cliche, people have heard this, probably multiple times, but stock market is not the economy. And,
Yeah.
the stock market, in fact, if you were to look today, things were really good in the stock market. And so
Weird. It's really weird.
it's really weird, but that just is not an indication. And all indications are that, with these unemployment figures, the economy is softening. There's no mystery around that. So, I don't want folks thinking, well, the stock market's doing great. My 401k is up X%. Why are we talking about low? They're not coupled directly together. So,
Yeah, and the data there is just as murky. None of this is financial advice. Do your own research, talk to financial advisors, of course. But yeah, I mean, you have Vanguard updating their report saying they're expecting 10 years of low stock market returns, 3% or less. You have Buffett moving to cash, a lot of cash, and freaking everybody out. There's a lot going on out there where some people in the know are signaling they also think that the ship is going down a little bit, but the ship keeps going up. Technically speaking, as people are making these moves, the stock market is continuing to rally day after day. It's not sitting down, it's not acting like it should. And that makes these predictions, even the predictions you and I make, even harder. If we go back 40 or so podcast episodes, we were probably saying we're not going to see below 6% by the end of the year. Now we have some new data on the table that says, Dave's saying maybe we'll see some
yeah.
fives peak in there by the end of the year. So we update this for you as we're going along. It's a very dynamic situation. And due to some weird things that happened, from COVID, things aren't all acting as they should, right? People have that high equity, in their homes. We have a lot of people who own their homes outright, like over 42% of homes have no mortgage. We have really low interest rates locking people in. We have an economy that was strong and resilient that really is only being beat down by political pressures and tariffs and uncertainty. There's no actual fundamental economic underpinnings if you set the sort of US debt cycle aside for the moment. There's no immediate macroeconomic issues. It's just been being manipulated by the political cycle. And so it is proving to be a little bit strangely resilient in the same way the real estate prices, even though they're coming down, they're not flying down. So things are happening in a more moderate way than we would normally expect, which makes predictions harder.
Yeah, definitely. And you bring up a really good point, Rich, when you talk again about the lock-in
Mhm.
effect. And for those that maybe this is your first podcast here, as folks that have really low interest rates, maybe, sub 4, maybe some even sub 3, high 2s. You know, maybe you bought or refinanced in the, during the pandemic, and you're not willing to go away from that rate to either buy a new home or trade your house up and take on a 6.5% interest rate. But if we start, trending and continue to trend in this direction, Rich, I mean, there's going to be a certain point where, the folks that have the, mid threes, all of a sudden something in the fives doesn't seem like it's that big of a variance. And they might be willing to, um, forego that locked in interest rate and sell that home and be willing to look at something in a 5% interest rate range.
Yeah, and there's a whole swath of buyers out there. From speaking of weird things from the pandemic, that when the rates they might have had a 3.5, a 3.675, and when the rates hit 2.5, they had their mortgages in forbearance because they couldn't
Yeah.
go to work. They were, economic hardship for people during the pandemic, and you couldn't refinance if you were on forbearance. And so there's a good chunk of people that came out of the pandemic with those mid 3 rates, like you're talking about, and the calculus is different from a mid 3 rate than it is from a 2.5 rate. And so yeah,
Yeah.
there is going to be a tipping point. And I think, and we're going to go over one more bit of news that might have hit you all, and then we're going to get into whether now is the time to jump off the fence and start buying now, and go into a little deeper how Dave and I would run those numbers, what our calculus would be before it would, make us jump. And the last piece, but I think that is a good point that I want to put a pin in to make sure we get back to there is that rate discrepancy and when that sort of settles out for people and becomes a null issue. But you might have also seen that we are seeing inventory continue to trend up. Right now, Redfin is got a new study out that is showing we have 500,000 more sellers than we have buyers in the market right now. That's a national number. They're calling it a national buyers market. They're saying this is the largest discrepancy they've seen between buyers and sellers since they've personally been running the data since 2013. Now, I believe those numbers are accurate. We're feeling that in our market as well. What I would push back on is the sense that there is any sort of national buyer's market going on here. I don't want to color people's perception that way. Real estate is hyper local and hyper personal. Here in our market, for example, in Placerville, we're more of a market in stasis. We're more of a neutral market. Where you're sitting in Folsom, Dave, I would say it's the same.
Yeah. Yep.
Um, Here in the West and the South, we're seeing inventory spike. In the Midwest and the Northeast, we're still seeing really compressed inventories, multiple offers, and upward price pressure because of the overall lack of inventory. And so this is going to be different depending on where you're sitting listening to this podcast. So I would set aside the more salacious bits of it's a buyer's market that Redfin's going out. They certainly have a dog in the fight of people jumping off the fence and buying houses, right? But I do think the trend is towards more inventory, and that trend will eventually probably spread to most markets that are not exceptionally insulated markets with a strong moat, like coastal real estate, unique real estate, that sort of thing. And so this is, again, we're not seeing blinking red lights yet, but we are seeing all the numbers: jobs coming down, inflation stabilizing, more people. There are more unemployed people than there are jobs for them to get. There are more listings than there are buyers to buy them. These are all pointing towards a down and to the right trend line on the graph for real estate prices, not an up and to the right one. So in that, for that reason, people are thinking is now the time to jump off. Interest rates are lower, things are getting worse. And my answer to that question is it really depends on you. This is where the hyper personal comes in. If you haven't watched we have a podcast and a solo video on the 5 real estate fundamentals. You should watch that one. If you are one of our buyers who meet those 5 fundamentals, you've got good income, you've got good savings, you've got an emergency fund, you've got good credit. And especially in this market, you have a long time horizon for owning that property, 5 or 10 years or more. You could buy 3 months ago, you could buy today, you could buy 6 months from now. You are the type of person that it doesn't really matter. If you bought now and interest rates continue to fall, you're a person of means with stable employment. You can take advantage of the refinance later. Where this matters for is those on the ragged edge, Dave, those people who are they haven't been able to afford it. They're really waiting. And I think the advice for them is different. So what would you say to those people who are on the fence and I really need this to be a little more affordable before I jump off the fence? Is now the time for those buyers to jump into the real estate market?
Well, I would say you consider looking and you change your profile a little bit. Maybe you start, we always talked about this, and there's another podcast about that. It may not be your white picket fence forever home, but if you're on the ragged edge right now, anyway, A is, if you do meet those 5 fundamentals, but you're on the ragged edge, you know, theoretically, it is the okay time for you to buy if the perfect opportunity comes along, but be patient.
Yeah.
I think that's one of those where, and we go out there and we've seen it so many times, Rich, where your threshold is X. You go out and you look at some properties, and all of a sudden you see a property that's a little outside your means, and you fall in love with it, and it's all of a sudden you're emotionally attached to it, and it just doesn't make sense. That's what we want to avoid.
You
So
start
if
making
you're
bad decisions. Yeah.
you making bad decisions. So if you're on that ragged edge, instead of doing the opposite, during the pandemic where, people were increasing the value by 25 or 50,000 of the home properties that they were going to look at because they knew that that's just where they had to be. Maybe you decrease the home value that you're looking at. So if you were looking at 500,000 your limit, don't start looking at 500,000 today. Look a little
Yeah.
bit lower, and then maybe those nicer or homes that were in that range come down to where you are. Um,
Yeah,
I
because
think
I think
that's
we've got more room to come down here. We are just
yes,
at the beginning of this.
yes,
I mean, things can shift on a dime because of the artificial way in which our economy is being manipulated right now. But the trend lines right now are all pointing, like I say, down and to the right, and we're at the beginning of this. So there is
yeah,
no immediate need to jump off the fence right now. I think, like I said, if you're a well capitalized buyer, if you have stable employment, and you see, like to Dave's point, you see the property you fall in love with, I don't think there's any problem with buying that today, because I think there is a higher likelihood that you will be able to refinance into a lower rate from today than there was 6 months ago, 8 months ago, a year or 2 years ago. I think it's looking like a higher likelihood you might get that opportunity in the future. But as long as you can afford it right now, no matter what, even if that opportunity doesn't come along, you're fine to buy. But I wouldn't say that what we've seen in the last week or two, if we went from interest rates just above 6.5 to just below 6.5, that spread makes a nothing. It's a nothing burger in terms of your monthly payment. Your affordability didn't really go up considerably. So I wouldn't consider what happened in the mortgage interest rates and what's happening with the job numbers as a signal for people on the ragged edge of affordability to dive right into this market. I think it is a signal to pay attention, get your ducks in a row, work the 5 fundamentals so you're in a good position to take advantage of some opportunities that are coming up. Don't shy away from one now if you're in love with it, but don't feel any pressure to be diving in right now, because I think the economy is going to continue to deteriorate, which will continue to present better opportunities as the course of this year and early next year come along. Does that seem like a fair statement?
That is very, very fair. And the other thing is, I always say, in this business, we usually don't know when we're at the bottom until 3 months later.
Yeah.
And we just can't, we can never time it perfectly. And so I think what the indicators, and at least as the market continues to shift like this, one of the other indicators is when you start seeing the investors come out.
Yeah.
You see folks that are, a lot of first time home buyers will come out, but who they might also compete with is that investor that has cash. They don't, not confident in the stock market anymore. They have some money set aside. They're comfortable with buying residential real estate as a rental, whether these are large corporations that snatch up properties or these are the individual investors. Those are the folks that when they feel like the timing's right and the numbers check out, that's when they start buying. And that's usually a good indicator that, it's a good time to buy.
Yeah, that's sort of the real estate equivalent of like follow the institutional money in the stock market kind of
Yes,
thinking. Yeah.
100%. Yep.
Yeah. And I think we can't, like Dave said, we can't time the bottom of the market, and we're not encouraging anybody to miss opportunities and sit on the fence longer and try to time the market. And that's why I think this comes down to your 5 fundamentals and your payment comfort. If the rates if you're watching this podcast, you're thinking about buying a house, hopefully you have taken our advice and contacted a local lender. Dave, if you're in our market, he can do loans in all of California, Nevada, or we can refer you to somebody else. But hopefully you've taken that step to talk to a lender and you figured out, hey, I can pay X amount a month. And if what you want to get for a house at these interest rates has hit that number for you, I think it's a fine time to get moving. But if it hasn't hit that number, I don't think you need to, feel the fear of missing out and YOLO into this market right now because we had a good run in mortgage rates for a week. I think there's still room to go. I think it is a reasonable market to be cautious, but not try to sit there until you time that bottom. But generally speaking, when a market shifts, the first people to move, the first people to jump, don't always have the best financial results. So having a little bit of patience here, like Dave said earlier, and waiting and seeing what happens over this Fed, announcement next week and maybe the next one, that could be a prudent thing to do if you're not a well-capitalized buyer, if you're on the ragged edge of affordability before you dive in here. So hopefully that helps you guys frame your thinking around this. We're not here to give answers. There's no sort of general real estate advice. It's good real estate advice. It's hyper local and hyper personal, but we try to give you some ways to frame your thinking, and things to look out for so that you can make the best decision for you when the time comes. I think that's a decent place to wrap it, Dave, unless you have another point you want to make before we jump off here. We could talk for another hour, but
yeah, that's it. We certainly can. And that's where we have those individual conversations. Remember that everyone's individual scenario is unique, and us having a conversation is a great way to start. And whether that, you're in the window to maybe buy this year or next year, it's never too soon to prep and kind of identify with, where you're at and where you need to be.
yeah. Awesome. All right, so we're going to wrap it there, folks. Again, if you've made it this far with us, thank you so much for watching. We've had some really great comments lately. People saying, "Hey, this channel should be bigger than it is." If you think that, go ahead and hit the like button, click subscribe, hit that little bell so you get to see all of our videos coming up. And if you don't like watching 2 middle-aged dudes ramble on about the real estate market, then don't click those buttons. That's up to you. Either way, we thank you for watching this far, and we'll see you on the next one. I'm Rich Curtis.
And I'm Dave Miller. Thanks, Rich.
All right, thanks, Dave. Have a good one.